Everyone, I'm Professor Stefan, and in this video we are going to talk a little bit more about our non-current liabilities, and we're going to cover the retirement of bonds and the fair value option. So let's get started. Bond retirement, put simply, is when we repay the money that we owe to our lender, right? And that extinguishes our liability. Now, firms have a couple options on when they can do this. Kind of maybe the most common one, and the one you expect based on the problems we've done so far, is to repay the lender and extinguish the debt or retire the bonds at maturity. So kind of when the contract states that this loan is going to end. But in some cases, firms may choose to retire this bond early. And so we're going to learn about how the accounting differs for these two choices. The nice thing is the at maturity is a pretty easy one. Retiring it early gets a little bit trickier. Now, if we retire our liability at the end of its term at maturity, the nice thing is our premium and discount has been amortized away, right? That thing is gone based on what we've learned from both notes receivable and our notes payable and kind of bond type problems. So if we hold it to maturity, the premium and discount goes away, and the only liability we have left is at the face value of the contract. And so when we retire this bond, we are going to repay it at the face value, and we're going to remove the liability at the face value. And that's all there really is to it. We're done because we know the premium and the discount have been amortized to zero. So a very quick example here. Let's say Chip Corporation issued $1 million bonds at a 10% coupon rate and a 10-year maturity. The market rate was 12% at the time of issuance. If the company holds the bonds all the way to maturity, we know that let's see, this would have been at a discount, right? So we know the discount would have been zero, and the only liability left is that face value. And so when they retire these things, they're going to repay the $1 million face value, and their liability of $1 million goes away out of the bonds payable account. Now, early retirement gets a little bit trickier because in this case, when a company wants to retire a bond early, they cannot just go in and repay the face value and everything disappears. There are going to be different rules about how a company can retire their bond early. And so the first thing they have to do is they have to figure out how much money is it going to cost them to pay off this liability today. And so in some cases, the bond terms are going to have a call provision. So it will set a price saying, hey, if you want to retire this early, you have to pay this, fixed amount of money. In some cases, that may not be in there, and what the company is going to have to do is they're going to have to go onto the open market and buy back all of those bonds at the current price. So they would have to buy them back at whatever today's price of the bond is, compared to at maturity, they just repay the face value. And that price today of a bond could vary based on how interest rates have changed. And if the price of the bond is not available, then they may have to retire it at kind of the present value of the future cash flows. If they know the current market rate, you can kind of infer the bond price from that. But so our first step is just figure out how much cash the company has to pay to do this early. And once we know the amount of cash the company is going to have to pay, they're going to compare that to the current carrying value of the bond. So the carrying value, remember, is just what we list our bond at. What is the liability on our books today with both the face value and the discount or the premium, if that exists. And the difference between what I have to pay and what I say I owe on my books today is going to generate a gain or a loss. So if I say my liability is $1 million, but I have to pay 1.1 million off to retire it today, well, that's going to generate a loss of 100 grand. If I say my liability on my books is $1 million, but I only have to pay 900,000 to retire it today, well, then I've got a gain of about $100,000. And finally, when we repay that thing, we're going to remove the liability from the face value of the liability from the bond payable account, and we're going to remove any remaining discount or premium. So the whole liability disappears because we have effectively paid this off. And so kind of put in simpler terms, since I know that slide kind of has a lot on it, just kind of intuitively so you understand what's going on, we are going to pay off the bond at the current market rates or the current price. And that's the trickiest part of this whole equation, I think, is figuring out what the current price of the bond is. And that's sort of the new part we're going to focus on. Then we are going to remove our liability, and any difference can get plugged to a gain or loss. So these are sort of your very simple steps if you want that for a cheat sheet to remember how to record a journal entry for early retirement. So let's walk through an example here. Let's say Chip Corporation issued these $1 million bonds at a 10% coupon rate and a 10-year maturity. The market rate was 12% at issuance. Now the bonds here in this case, we're changing the example a little bit, have a call provision at 97. And that means Chip is allowed to retire these bonds early if they're willing to pay 97% of the face value of the bonds. Remember when we have kind of a bond price, at 97 or 103 or 101, whatever that might be, that is kind of the percentage of the face value. And so on January 1st, 2022, let's say the company calls these bonds, they want to retire these things early, and the current carrying value, so the book value of the liability, is $939,254. And so our first step, remember, is going to be how much cash do they have to pay? And so we said with this call provision, they are allowed to retire the bonds at 97% of the face value, or $970,000. And I apologize, that should say the face value is $1 million instead of the $100,000 in that little equation. So they can redeem these bonds or retire these bonds for $970,000 because it has that call provision at 97. So then the second step is figure out what is the gain or loss on this thing, right? If I'm paying $970,000 to retire them, I want to compare that to what my current books say is my liability. And my current books say my liability is $939,254, right? That's the carrying value of the liability. And so if my books say my liability is $939, but I have to pay $970, that seems kind of like a bad thing, right? That's going to generate a loss here of $30,746. Now, the third step is removing the liability from our books. And we know we can remove the face value from the bond payable account. That part is easy. But we have to remove also whatever the current discount or premium is. Now, in this case, because we have the carrying value, the current discount or premium is pretty easy to calculate. Remember, it's just the difference between the face value and the carrying value of the note. So we can take this $1 million face value, subtract the current carrying value of $939, and we get an unamortized discount of $60,746. So at this stage, we have all the information we need to record this journal entry. We know we are going to pay cash of $970,000. We know we are going to have a loss of $30,746 because we compared that cash to our carrying value. And then we can remove the old liability. So we debit the bond payable face at $1 million and we credit the discount at $60,746. So early retirement of bonds is not easy. There are a handful of steps here. Feel free to put kind of this summary onto, your cheat sheet so you remember the steps it takes to get there. But you got to figure out the cash you have to pay. You have to remove your old liability, and the difference between those is your gain or loss. So our second topic for today's video is the fair value option. Now, the fair value option says that companies can choose to record their liabilities at the fair value. So everything we've been doing up until now is what we call amortized cost, because we kind of take the cost and we amortize that discount or premium over time. Instead, what companies can choose to do is to record their debt at the fair value, and they update that fair value every year. Now, once they choose the fair value option, they have to stick with it over the life of, that note or that bond, and they can choose different choices for different notes and different bonds. So they don't have to pick one option for all of their liabilities. And so at issuance, they're going to record the liability at the fair value. Then every single year, they're going to adjust that liability to the fair market value and report the adjustments as unrealized gains and losses that go into net income. So you're going to have big net income effects if the value of these liabilities changes. And so conceptually, let's think about the bond value going up. So the bond value would go up if the market rate falls from when you issued that bond, right? And so if the market rate goes down, that means your bond is comparatively kind of paying a higher rate. And if your bond is paying a higher rate, then the value of that bond goes up to the market. And so if the liability value goes up, then you have to credit your liability because your liability has gone up, and you debit an unrealized holding loss. And so effectively, it's kind of like that early retirement where now we would have to pay more to retire this bond. And so we have to increase our liability and debit a loss. Now, if our bond value goes down, that means that market rates have gone up from when we issued the note or the bond. And so if market rates have gone up, then comparatively, kind of our note or bond is paying a lower rate that becomes less desirable. And so the market value of that liability goes down, and it'll cost us less to retire it today. So we're able to debit our bond payable to make our liability go down, and we can credit an unrealized holding gain. This is one of those topics that I think can kind of get your head spinning a little bit, because you have market rates adjusting and then you have liabilities adjusting. So feel free to take a minute and kind of think through this a little bit. You could write out some notes. Okay, if I, issue something at 5% at face value and the market rate goes up to 10%, how does that change the demand for my bond, et cetera? And we can talk about this in class as well to try and clarify a bit if it would help. So the upside to using the fair value option is that kind of your liabilities are more timely and more relevant, right? This is what the actual value of your liability is today if you wanted to retire this liability today. And so it allows better comparability across firms if everything is stated at fair value. And it changes your liability and recognizes the gain or loss when those events actually occur. And so it doesn't kind of put off these things until a later date. Now, the big downside here is that these gains and losses go into net income, and they're largely driven by changes in market interest rates, which are outside of the company's control. So it could add some volatility into income and make it a little bit harder to assess how the firm is actually performing. And second, fair value can be tough to determine, especially for kind of privately held notes, right? You may have to estimate what a market rate is or kind of what that would go for on the market. For publicly traded bonds, sometimes they're not traded very frequently, and so the last trade can be a little bit stale, and so you may not be sure what the current market rate is. And so the estimation piece of this is also definitely a challenge. And so I want to talk for a second about kind of how we determine the fair values of these liabilities. And it is going to depend on the liability itself. There's no kind of one set way to do this. It's going to depend on what information we have available. And so what GAAP wants us to do is use the most reliable information we can. And so we're going to classify our fair values into 3 buckets. If we can, we're going to use a kind of level 1 classification. And this is where we have observable market prices for identical assets or liabilities. And this is also what we call mark to market. So let's say you have a publicly traded bond, and that thing is traded every day. It is a very large bond. It's very liquid. People are trading it back and forth all the time. That would be kind of a level 1 valuation because the price is set by the market. It can be observed, and it is very up to date, if you will. And so we know exactly what the value of that liability would be. Now, our level 2 valuation adds a little bit of uncertainty. Let's say, for example, our bond is traded on a market, but it's pretty illiquid. So people only trade every once in a while. Maybe the last trade in this bond was 3 months ago. And so we can say, okay, we know what the price was 3 months ago, but how has it changed over those 3 months? And so what we might have to do is kind of add in some calculations of our own with kind of how the price of other bonds changed over those 3 months, how have yield curves changed or treasuries changed over these 3 months, and do a little bit of kind of our own analysis to get what the current bond price would be. Or maybe we would look at kind of a competitor's bond, right? Maybe that was traded yesterday and has a good price. And so our level 2 inputs have some things that are observable, but it is not an identical or an exact kind of price that is as reliable as level 1. And now if our liability has no observable inputs to calculate the fair value of this thing, then we're going to call this thing level 3, and it has unobservable inputs. And this is going to be based on the firm's assumptions, or what we call mark to model, where basically they are going to throw some assumptions into a valuation model, and it's going to spit out the fair value of that liability. And it is only as reliable as the assumptions that the firm makes. But there is kind of nothing observable out there about the value of this liability. So let's do a quick example here to show how this fair value option works. Let's say Triton Inc. issued $500,000 bonds at 6% coupon rate at face value on January 1st, 2016, and they elected to use the fair value option. Now we get to the end of 2016, and let's say the market rate has jumped up to 8%. So everybody else's bonds are now paying 8%, and mine only pay 6%. So, on the market, those 6% bonds are not going to be quite as attractive. If I'm going to buy a bond, or I'm going to loan money effectively, and I'm going to get a 6% coupon rate. We learned about this kind of with notes receivable and the first bond class. If I'm going to loan my money and get a 6% coupon rate, where I could get 8% somewhere else, well, then I'm going to loan less money than the face value of that bond, right? This is where the intuition with these changing market rates come from. And so the value of this liability, what somebody would be willing to lend me today, kind of goes down. And so the fair value of the bonds drops to $480K. Now I want to emphasize, the company already borrowed the full $500,000. So this is just the value of the bond on the open market as people kind of trade it between each other. So if you originally loaned me $500,000 and then you went to try and kind of sell that receivable, right? Because that's what the lender has. They have a receivable. If they tried to sell that on the open market, they would only get $480K for it. And so the lender in this case would have a $20K loss. But for Triton, who borrowed this money, if they're recording their liability at the fair value, well, then they brought in cash of $500K initially and record a liability at $500K. But the fair value adjustment here, my liability has now dropped to $480,000 because I could buy that back for $480,000 and retire the bond if I wanted to because of this change in the market rates. And so if my liability drops by $20,000, well, then I can recognize an unrealized holding gain of $20,000 as well. And so you can see that as market rates are going to fluctuate, my liability is going to fluctuate, and the changes in those liabilities just go to our income statement. Closing thoughts. When we retire our bonds at the end of the debt term, we just remove the bonds payable at the face value and pay that cash at the face value. If we do an early retirement, there could be a gain or loss, and so we have to pay the cash at the current fair value, remove our current liability, including any premium or discount, and any difference between those is the gain or loss that we're going to record. And finally, firms can elect to use a fair value option for debt